Welcome back. We hope you all had a lovely lunch today. I once again request all of you to please, our delegates to please come forward and take the seats in the front. There's a lot of space. While we are settling down and getting ready for the second half of the FEED 2024, I would like to take this moment to thank our sponsors and partners once again, our platinum sponsors, Danfoss and Schneider Electric, our gold sponsors, ABB and Carrier, our silver sponsors, Eurovent and Idam Infrastructure Advisory, our session sponsor, Tabreed India, our outreach and network partners who helped us reach out and to our stakeholders, ASHRAE India Chapter, GBCI India, Griha Council, ISGF, RATA, and our knowledge partner, Institute for Energy Economics and Financial Analysis. Once again, I request our delegates to please come forward and take the seats in the front. I don't see anyone moving. It's okay. Should we start? Thank you very much once again for joining us at FEED 2024. We hope you all had a lovely lunch, and it is also a time when you all might start feeling a little lazy. So I would just like to start with a little bit of, something that some of you may like. Please mind me. Please, let's do that. May I request all of you to please stand up? Just to shake off a bit and get energized one more. Lovely, and give a big round of applause for all of you for being here, for your contributions and commitments in the sector. Thank you very much. Each one of you is very, very important, and your voices matter. Thank you so much. We now move on to our next session, which is titled Money Matters, and Money Does Matter. Money Matters, Policy and Market Reforms to Scale Up Energy Efficiency Financing in India. This session aims to examine the crucial aspect of funding energy efficiency initiatives in India. It will address the substantial investment gap projected until 2030 and the annual investment target of $840 billion set by the G20 Strategic Action Plan. The discussion will primarily focus on strategies to bridge this funding gap, exploring key capital resources, including utilizing private investment and blended finance mechanisms. We would like to thank the Institute for Energy Economics and Financial Analysis for their support in designing this session as our knowledge partner. We will take the questions from the audience after the panel discussion, so please keep your questions ready. I would now like to introduce the session chair and panelists for our session. Please take the stage as I call upon you. The session will be chaired by Dr. Dhruba Purkayastha, India Director, Climate Policy Initiative. Dr. Dhruba has over 30 years of experience in credit rating, management consulting, investment banking, engineering industries, and international development financing. Welcome, Dr. Dhruba. We have a panel of 3 distinguished experts for this particular panel discussion. Firstly, I would like to call on stage Mr. Bradford Dockser, CEO and co-founder, Green Generation. Throughout 2 decades of real estate investing, Mr. Bradford was a principal with McFarlane Partners and the founding partner and managing director of Starwood Capital Europe and Starwood Capital Asia, overseeing operations in each region. Welcome, Mr. Bradford. Our next panelist is Mr. Parag Sharma, founder and CEO, O2 Power. O2 Power is a renewable energy platform established in 2019 and is developing renewable energy projects in India. Mr. Parag has over 25 years of experience in the power sector and is also involved in industry associations, serving as chairman at CII and president at WIPPA. Welcome, Mr. Parag. We also have with us Mr. Saurabh Suneja, Director, National Investment and Infrastructure Fund. Mr. Saurabh has 19 years of experience in the fields of infrastructure and financing and investments, public-private partnerships, regional infrastructure planning, developing policies and regulations related to infrastructure, transaction advisory, and feasibility assessments. Welcome, Mr. Saurabh. I would now pass on the mic to Ms. Dr. Dhruba.
Thank you, IEEE, thank you, and good afternoon. We have a session, and I'll jump straight into it. You have 3 panelists who have been introduced, and I have also been introduced, and the session is called Money Matters. So, we have 50 minutes to discuss, and I believe I have 10 minutes after that for questions. Please let me know. So, money surely matters. But the problem that I'm getting, or what I'm hearing, is money matters for sure, but matters much more for energy efficiency. Money does not flow into energy efficiency because you don't see, you don't feel. It's an impact which is happening. Money flows into renewable energy. There is a massive scale transformation which appears visible. But when you make invisible differences towards the same goal of reducing emissions, reducing energy consumption, and when there is viability and there is service provision, then money does not flow there. And that's exactly where the problem that we are placed with. That money surely matters, but money does not flow to such an important sector which is a low-hanging fruit in this net zero transition, NDC, all of it, and essentially often called, in parlance, it's often called as negawatts. So negawatts is what you save. The problem that we have is creating infrastructure, creating solar, creating large plays to achieve the same mitigation in carbon when you have an industry which emits. So it's something like this, that when you go green, that's great. For example, if you put up renewable energy, that's great, which is fine. But good cannot be enemy of the great, right? If I improve on energy efficiency, if I improve on emissions, then the finance does not call it green, it calls it black. Therefore, there is a need for transition. There's a need for transition finance to flow of saying good is not enemy of the great, it's achieving the same goals. So with this introduction, my first open question, which all of you can take, and before I get into dwell into the specifics questions for each of you, is what ails the energy efficiency sector primarily, Brad, you can take it globally or built environment if you wish to. What is it that ails? Is it policy? Is it institutions? Is it lack of financial instruments? Why is it not looked at as like a green, like the scaling up of green industry? Is it policy, institutions, finance? Where is the problem? Your views, starting with you, Brad.
First, let me just say I'm honored to be here. I think it's everything. It's not really technology, because I think the technology exists. I think it's much more about the business model. You know, if you own an asset, you own a business, in many cases, you don't know exactly what to do. On the other side, capital markets don't finance dreams. They don't finance aspirations. They need to know what the cost is. They need to know what the savings are. They need like project financing, they need a pro forma that's built up so they know what they're financing. They don't have that. To some extent, there's a capacity issue. You know, the people that install, the people that put the projects together, and I think our experience around the world has been, it's less about a single technology. Most people want a solution. And technologies by themselves are not solutions. It's when they get put together, it's when the efficient air conditioning gets integrated with controls and a BMS, that there's a cool roof that will reduce the heating load on the building so that the HVAC and the cooling can be more efficient. And putting that all together. And there are many markets, Japan for instance, that is very product driven. They don't really think about solutions. There are parts of the world that the regulatory environment really is about incentivizing. In a North American context, just for example, there's very little leadership at the U.S. level, the national level. Most of the action has been at the cities. Cities saying, here are our priorities. That would equate, I think, to the states in an Indian context. In Europe, it's very much at the national level. In some cases, people give incentives to get them to do certain things. Increasingly, we find, and there was a reference to this morning, that cities in the U.S. are creating BEPS programs, Building Energy Performance Standards, and they're creating carbon, basically taxes. And so they're saying if you don't improve your efficiency, you're going to have a cost. It's going to cost you something. New York, Boston, Washington all have that. It's getting people to do things very quickly. But I think, you know, the problem is so big, is so intractable, that has to be everything. It's use less efficiency, it's decarbonize renewables. Every part of it is really important. But I'll just sort of stop for a second. You know, what we believe is that it's profitable. You know, the name of our firm is Green Generation. That's really a double meaning, because it's both green in an environmental way, but it's also green that it's profitable. And we know, because of the work we do all around the world for leading investors, that they can drive a financial outcome. They can improve the value of the assets, the value of their business, but also have a very positive climate impact by decarbonizing and reducing greenhouse gases.
Thanks, Brad. Parag?
Yeah, so I think what is missing for this sector is a proven business model. So if I talk about my sector, the renewable sector, we have standard bidding documents. We have a structure in which government calls for the bids. We have a structure in which there are REIAs who are very AAA rated entities. So the whole structure is very scalable. FY23 did its only 15 gigawatt of bids. This year they're talking about doing 50 gigawatt of bids. So moment they scale up the bidding size, the whole sector grows along with it. Similar to that, I think in the energy efficiency domain, there's no standard bidding documents. We really don't know whose job is what in a ESCO contract. So we hardly see any standard ESCO contracts. We don't see any insurance company giving guarantees that this, if you do X amount of investment, you have a certainty that you will get so much savings on the electricity, and it is backed by an insurance company. So this thing is missing. We don't have a security on any stream of revenues. And as Dhruva said, if this can fall under the carbon revenues, that would be very helpful for the entire industry. Because then you can say that yes, we have minimum so many CRs which you are generating by saving so much, and then we can really price those CRs and say that yes, at least this much is a fixed revenue. So the entire business model is missing, and there has been no precedence, and that's why for any investor, whether it is equity investor or a lender, it's a very difficult sector to invest in.
No, thanks, Parag. Yeah, Saurav. So I'll have some follow-on questions.
Thanks a lot for the broad question. To respond to it, I'll pick up from something that Parag had started to say, and you know, he is deep into the renewable energy space. I think see for me also the diagnosis is pretty similar, which is about business models that can be created so that more capital is funneled into opportunities. And I think this was a similar point that Brad was making. Given that NIF is a infrastructure investor, or we are heavyweight on infrastructure, but we have a very broad aperture, I'll therefore try to go a little bit broad in terms of what we have seen happen, and where energy efficiency could you know, start to take a leaf from the experiences. So what at least we have seen is that within the life cycle of NIF, which is a little over 6 years, we have seen very interesting business models start from scratch. So for example, the municipal e-buses, which has a very, you know, good climate positive impact, this business model is now fairly well established. Similarly, I was talking to some of you about smart meters, where the business model is now on a pretty good footing, and that's because, you know, the government stakeholders, as well as, let's say, lenders, banks, equity providers, businesses, they understood step by step what were the hurdles in making it a smooth and efficient financing mechanism, and slowly but steadily all those hurdles or hindrances were actually taken out, and therefore companies were able to build large scale businesses around those themes, and capital poured in. Over time, bankers become comfortable, and therefore debt capital starts to pour in certain aspects. Government, partial or, you know, small slices of government subsidy also has supported some of these sectors. So, you know, there are experiences or examples of what are the tools that need to be brought together to help scale a business model that is good for society.
No, thanks, Saurav. I think great opening remarks, which are some sort of cues for me to follow on questions, but I'll kind of little change the order because may be useful, and I'm coming to you, Parag, for the first one on the specifics that you picked up on, the lack of business models, lack of standardization, lack of standard bidding. We do not know the now. Let me just push you a little bit more, that if we look at Bureau of Energy Efficiency, I mean, there's an encyclopedia of technologies which are in place. If you look at business models, we are probably here talking about a holistic energy efficiency for sure, but we are also talking about what is a business model which is called ESCO, and which has partly succeeded as a RESCO, by the way, in solar. As you rightly said, it succeeds in solar, and very clearly in your industry, even a RESCO model has succeeded, and all of it is RESCO. Now we have an ESCO model, which is also, well, standardized means there's no SECI in between to create that, but I won't say it's absolutely non-standardized. There are two forms. One is a shared risk contract, one is a complete risk contract where you get paid by the savings, another is savings thing. But I do get your point on the security and certainty and the need for a surety, and which is not credit, which is some sort of a performance, can correct me if I'm wrong here. So, having said this, what is your view on saying that, yeah, how do these ESCOs, one, need not always be ESCO? It can be the industry, it can be, I'll come to built environment to you, it could be anything for that matter, where, as Saurav was saying, what some bit of confidence, some bit of experience will make first an equity and then bank debt or credit to flow. Just to give you a small number, if you consume 1 unit of electricity less, that means you're producing 2 units of electricity less. So one on a carbon credit dimension, and that was an interesting twist Parag you brought in, is that if I consume 1 unit less, a negawatt is equivalent to 2 units less produced, which means, well, rationally it should get 2 units of carbon credits for an equivalent carbon in that matter. So this is, now if a solar produces 1 unit, it gets 1 unit of carbon credit on electricity corresponding, or whatever units of 0.97 or whatever 9 the carbon emissions is. But on energy saving, you actually get double the number of carbon credits, and if it can be brought into the national carbon markets, there you go. There is some sort of a certainty. So request for your views on that.
Right. So in at least in our sector, any revenues coming from the carbon market is considered as an upside. They are not considered as a base case, because this is a market which has been fluctuating a lot. So there's a lot of deals in our sector where the incoming party has given a huge value on carbon credit, and when the market was down, the reverse has also happened. So as an attempt, yes, it's a good initiative that at least this whole revenue stream should be opened up. But we are seeing inordinate delays in getting your projects registered in GCC. We really are not sure about how much revenue you will get from there. So it can be considered as an upside. It can't be considered as a base case for any investor or a lender in that case. I think what any investor will look for is that yes, there is a transparent way of defining the baseline, and then there are enough clauses built to give comfort to the investor that whenever there will be a saving, he will get the money. The required change in law, force majeure, all these things are built in the contract. And it has been proven with time that yes, the money really gets earned. So I think that is the thing that we need to focus on. The carbon thing is an upside on top of the base case.
Sorry, just to continue my question with you is, so what, in order for me to understand better, so what you're basically saying is 2 things. One is that savings need to be guaranteed as a performance. Have I got you right? One, and the savings in electricity translated to whatever price is carbon or electricity per se, that forms the basis for financing.
Exactly.
And the upside on voluntary carbon markets is an upside. The uncertainty is so high that an investor does discount it. So if we built in certainty into the carbon price, if institutionally policy and built in certainty, then that can be added. Am I getting you right?
Yeah. So building a certainty on a carbon price is not in the hands of any policymakers. Yeah, it's an open market.
Fair enough. So certainty in the savings, and therefore a performance guarantee over there provided by an insurance company would be an enabler of finance.
Right.
Am I correct here?
Right.
Okay, thank you. Let me get to Brad. Brad, you have experience in the US, and we have had seen PACE programs and which were, and you have been experienced in built environment. If I talk of India, well, all numbers, whether it's McKinsey or any urban department, talks about 70% of India is yet to be built, or 60% maybe now. So I'm talking of a dated report, but if 70% of India is yet to be built, the built environment is going to a huge consumer of energy. It's probably the second largest emitter in that sense if we look at the electricity consumption. So every unit saved over there, and this element of a PACE program which has been reasonably successful, irrespective, just the Indian structure is more federal. So you have a centralized Bureau of Energy Efficiency which can then look at the states, unlike in the US where the decentralization of the state empowerment is much higher. So here you can, for that matter, if the federal chooses to, or the center chooses to, it can therefore create a compulsion by the Constitution itself. So how do we get such a PACE program going? Any views or thinking? Because that, to my mind, will be a huge mover of energy efficiency. And when it's tied to building, I would be kind of inclined to think that it is easier financing, but please correct me, I may be wrong.
Yeah, so it's a great question. You know, PACE, which is essentially on-bill financing in the United States, is at the, actually it's at the level that puts the real estate tax on a building. So it could be a state, it could be a city, it could be a county. People typically are using it either because they don't have access to low-cost capital, they don't have the ability to borrow, or there's something about the lease structure. So it's an office building or a multifamily where they're trying to align the cost and benefit. When PACE started, it was really focused on upgrading buildings. What's been interesting is that the growth in PACE in North America really has been for new construction. And I think that's where the really interesting parallel is to India. 70% of the buildings that need to exist in 10 years have, as you said, have not been built. Where it's used in North America is to incentivize construction for high-performance buildings. So going above building code, going above the relevant ASHRAE code, where they'll incentivize or give lots of capital to essentially think about life cycle versus first cost. So you're going and building a much better building, which then is typically more resilient in terms of weather and climate. It uses less energy, and it is often more attractive to occupants, stakeholders, and communities. The other place I think it might be is interesting in an Indian context is in California. PACE has specifically been allowed to actually create and do upgrades for seismic. And so because the earthquake risk is so great there, California has said, this is a public good, this is really important to us, so we're going to allow PACE to actually be used for seismic. And the way PACE works, I think the capital comes from a third party, so it's a bank, it's a fund, it goes through the real estate tax bill. The challenge in the United States has been that because it's on the real estate tax bill, it's senior to the mortgage. And so the mortgage holder has to approve it. And I think in an Indian context, for it to be successful, you know, the major lenders here would need to pre-approve and essentially say up front, we all agree that even though there's something that's senior to us now, the asset's worth more, there's better collateral value, the loan to value actually will drop. And so we're in a better position even though there's something more senior to us. It's a really interesting question as a way to deploy capital, because I think it also goes to business model. It's fairly standard. The documents are standard. The administration is standard. There's a finite number of energy conservation measures or technologies that go into it. And it would be a very, I think, good way to streamline the process, because energy efficiency, certainly the average project is much, much smaller than the average utility grade renewables project.
No, thanks a lot, Brad. This was quite clear and useful to think through how PACE-like new built environment could probably have such thought processes in terms of on-bill financing. But there's a lot where the municipal incentives need to come in. Over here, incentives are municipal local bodies. But before that, I will come back to you, Brad, on this, but sort of the idea of that business model, the idea of unviable business model, which you alluded to and Parag also tried to talk about, and about a need for subsidy in some way. The question is, what is it that will make such business models viable? My question is pretty specific in the sense, if we get energy efficiency done, whether it is for electricity, heat, anything to do with oil consumption, all of it is energy. So the question is, what will make the business model viable? Because we are coming back to one question repeatedly, that apart from the guarantee, which Parag alluded to, the certainty and the guarantee. And the guarantee and the certainty is, yeah, I mean, it needs to work in exceptional situations. But there has to be a thought around this. And could it at all, why I'm asking you is, could it at all be considered as infrastructure? Could this business be an infrastructure? Could this business be an NIF initiative of creating energy efficiency infrastructure? And that's where my question of VGF subsidy comes in. So it's a distant question. Given the background in infrastructure that you have, I'm just getting you to start thinking, could this be an infrastructure at the first place? Because he was talking about standardization. He was talking about, we were having a conversation of saying, there is no SECI over here. Could this be an infrastructure?
All right. I don't know if it was by design, but this looks like a wrapped question which has a few layers. Let me start at one end of it.
I mean, I'm just looking at a viability of a business model and therefore money to come in.
Sure. So I'll try to answer the various aspects that you talked about. So one, I should clarify that NIF is not in any way restricted to infrastructure. There is no, right? So we are a equity provider. So unlike, let's say, a RBI regulated entity that might be restricted by regulation by the harmonized master list, and by the way, that list itself is evolving, and my understanding is that very soon we'll have a slightly new
The master list does not have energy efficiency.
Right, but you know that itself is an ever-evolving thing. So I would say that even the standard that we refer to is not a constant standard, but we are anyway not shackled by it. Let's say
Not shackled by that.
Yes,
Great.
yes.
Yeah.
And I think ultimately any business that and see essentially what are we trying to do as NIF? I think we are required to invest capital today on behalf of our investors into viable business models. Hopefully that generates money over a relatively long period of time, and we would have different calibrations of risk and return. And therefore, I believe already we are into many businesses that we are not calling them energy efficiency, but there are businesses that we already are in that are thriving on energy efficiency. So I'll give you two quick examples, and I'll try to come to the second level of your question. So I was reading the AEEE G20 report, and one of the issues that it was talking about in the built environment was the slight divergence that the capital owner may not be the beneficiary of an energy efficiency initiative. I was reflecting on that, and I think the beautiful contrary aspect to that is that when you are in the business of infrastructure, typically you don't face that dichotomy. So I'll give you a quick example. We are into data centers, and there our clients are some of the relatively most sophisticated companies in the world would be our clients, and they're demanding energy efficiency. And you know, if you look at the data center industry, there was a point of time that if you have 1 unit of IT load, you would have an equal amount of IT load for the cooling and running of that building. We have now come to that as a factor of 1.2 times. So we are, you know, kind of coming to the end of that efficiency curve, but people put a premium to how efficient your data center is. Secondly, you are able to roll up that efficiency into a more competitive price. So we would love those kind of businesses where our clients are asking for it actively, and we are able to make money doing it. I'll quickly come to the second question that I thought I caught in terms of you know, how to think about these viable business models, and you know, how to actually do this. One of my bosses, I remember, he used to tell us that in India, true innovation is not about strategy, it is about implementation. So I think it's about picking up a kind of a business model that we think that works and blasting it out of the water. And I'll give you a few instances where this has been done. One tool could be, let's say, pick up a slightly dated but a very large government building and say that you will drive energy efficiency there and put it like a demonstration project. Because I believe there is a lot of mathematics that needs to be built around it. How do you measure a baseline? And you know, several of our organizations are, for different portfolio companies, are trying to develop that green footprint baseline these days. So how do you have the baseline? How would you measure efficiency? How would you therefore incentivize the entity that has made the initial capex? And I believe, again, I'll go back to, let's say, the smart meters business model, where we don't have a SECI. We have a distribution company that is on the other side. And how do you make that business model work? And people crack that code by saying that, you know, you need to have a payment guarantee mechanism that works in that system. There is a small element of subsidy that is not very different from, let's say, the PACE program, where there is a sliver of subsidy that sits on top of a business model, and then, you know, people just rolled up their sleeves and solve a sequence of problems, which now makes the business model work.
Thanks. Just hold the thought here. I have a follow-on question on this data centers, which was quite interesting, because if you say that the data center is reaching its peaks of efficiency and energy consumption, which means the next unit will be even much harder. So are we to believe that, yeah, because they are large, and by the way, their computing requirements will keep increasing, not only by search, and as we have generations latching onto ChatGPT, you had it. So therefore, you then have huge amount of computing, and that requires further huge amount of cooling. So is it reaching peaks, and how does that business model work? It is, or did I get you wrong?
No, it's absolutely right. It's a hugely pertinent question, and I think something that Parag talked about, I'll try to weave that in as well. See, I think when you know, there are different levers of efficiency, and I believe making the whole building itself more efficient was the lowest hanging fruit. But that fruit probably has been picked, so probably getting to 1.1 times is the limit that we'll reach. The next lever which is still working is the whole Moore's law, which is that the initial 1 unit of computing power is still getting rapidly efficient, and it's about how do you allocate capex to make your data center most current and therefore most energy efficient. That mathematics different operators keep on doing. I believe the next frontier that is coming, and it's very interesting the way you framed the question, in an entirely different business that we are in, cold chain. Again, highly sophisticated clients that we have, they are asking that, are your cold chains running on mostly green energy? And this question has been asked anyway for several years about data centers. And I think this ask is becoming more and more nuanced. I think in some of the more sophisticated economies, it is no longer sufficient for a data center operator now to say that we are buying energy credits or green credits. Now it is about additionality. And therefore, you know, people are entering into virtual PPAs, which is a slightly advanced form of you not getting the exact green electrons, but making sure that you enter into a contract that allows you to reach additionality. So I think frontiers of efficiency and greening will keep on getting tested, breached, and then you will arrive at the next frontier, and there will be a business model built around it.
Sure. Let me go to Parag from here. Now this requires, as you said, Parag, some time ago, that requires a price on carbon, and that price is inconsistent. It's a market, and therefore past experience, and we don't have that market mechanism. Also, we don't have a CDM, which you and I have looked at some point of time, and you don't have that 6.4 established, even if some 3 COPs we are continually talking it has not been. So we don't see the light of 6.4 because there's no agreement on creating that CDM mechanism. Even that was a market. And why the prices crashed then, if that's the reference that you're drawing from, is while the EU ETS continued, but we saw the compliance demand out of CDM suddenly vanish, and therefore it fell from 50 euro to less than 1 euro. And that's the crash that you're referring to now. The question is in the domestic market, right? So we added the savings. We need, Saurav is pointing to greening, and therefore this needs a certain price that somebody needs to pay. And what I was coming to you and in your business model is, and I'll come back to you because I'm trying to link that to municipality, is the model of saying solarize all the lighting systems, public lighting systems. So we have seen projects where municipal lighting, well, not strictly sure whether it is energy efficiency. For sure it is. It is energy efficiency in any which way, because that consumption is going away, that production of coal-based power is also going away, so therefore does have a price on carbon and also has a saving for the municipality. So, would that be an infrastructure bid out, standard contracts, could it get financed? So you have 100 smart cities.
Yeah, so first of all, coming to carbon, so there's still a way out for putting energy efficiency under clause 6.2 of
It is government to government.
UNFCCC. So there
Yeah.
are things like offshore wind and storage, which are part of 6.2, and then the two countries can negotiate.
Yeah, which is G2G.
Which is G2G. So that window is still open, and energy efficiency can fall under that. Now coming to your idea of whether these public energy efficiency projects of street lighting and all, whether they can be financed. Obviously they can be, and if there is a model in which the revenue streams of this OPEX vendor who is actually installing all the street lights and getting revenues on a long-term contract basis, obviously that work, typically it's very similar to this multiple distributed generation schemes that Ministry of Power is having, like Kusum schemes and the other schemes. So all of them are typically project finance.
So we need a scheme, and that energy efficiency scheme, some indication of a policy action required, some indication we are getting of the performance guarantee for savings. So we are taking away a lot of things from this discussion that we are having in terms of key inputs which can be gathered out of such a conclave to provide inputs to the policymaker. That's what is, and the regulator maybe, and that's what is extremely useful. Brad, coming back to you, is the issue of built environment. Now, built environment has got a lot of standards. You have green buildings, you have green building standards, each of them. There are many of them in India, IGBC, US IGBC, USGBC, you have TERI, GRIHA standards, you have. So all of these standards are there. Now, when you talk of built environment, do you separate, when you're talking of new built environment, and we are talking about a retrofit and a new built environment, would it be a service? Would it be built into the property developer? How does this model work in terms of, yes, this is a huge impact on energy efficiency, more efficient buildings, but there is a confusion of how we need to look at, does energy efficiency in your mind is about retrofitting existing buildings only or going ahead? And if so, how are the business models different here?
It's very much both. And when you,
Both.
when you're existing buildings, you're absolutely talking about operating carbon. But new construction, there was a question asked this morning about embodied carbon, and I think that's with all the new construction going on in India, embodied carbon has to be part of the conversation. And if the government thinks that that's important to focus on, then that's where incentives can come in. And the incentives can be positive, giving people money for doing something. They could be negative. They could be basically, you're going to pay a
Right.
fee if you do something.
Sure. That's the need for regulation was my next, you prompted it. So when you say negative, is there a need for regulating?
Countries have done both, and they've switched. Europe used to basically do the stick, and they said if you do something bad, a carbon tax, and all of a sudden they changed and said we're going to start incentivizing to do certain things. And the U.S. did the opposite. They basically used to give incentives, and all the money went to people that were doing it already, and it didn't get really change behavior for those who were reluctant. they've now gone to a stick with carbon taxes at the city level in almost every major U.S. city. So I think, there's room for both, approaches. And we certainly think about efficiency both for existing buildings and new ones. And I want to make one point, because we talked about guarantees, and I think the reason guarantees exist in the ESCO model is because there's a lack of confidence in most of the firms that are doing the work. In the mostly around the world, when we work with governments, they want guarantees. That's just how they work. Almost none of our private sector clients, Blackstone, Deutsche Bank, Macquarie, the big investors around the world, none of them, absolutely none of them use guarantees. They spend the time to understand the work and what we're doing, but they do not, in any case, ever ask for a guarantee because they don't want to spend the money because it's more expensive, when you have a guarantee in place.
Yeah, that brings me, I know Parag has a comment here. It's the difference between a rule-based banking system there and a relationship-based. So the question of guarantee over here is not guaranteeing the lender, but what Parag, and please correct me, what he was talking of is, well, it could be a performance guarantee from the Schneiders of the world or whoever can do that, but the point is, it's the guarantee for the operational performance. You had a comment, please carry on.
Yeah. So if we compare this with our renewable sector, so what we are talking about is that all these projects, ESCO projects, can be financed if you have clarity on what you are delivering, and then you have a good payment security mechanism. If these two things are there, then this project will be financed. I think in the ESCO model, the first thing that whether we are measuring the right thing and whether it has been defined in the ESCO agreement can be resolved by saying that, look, this is the baseline and there is a third party, which is TUV or UL or DNV, who will independently verify whether the reduction in the energy consumption has reached or not reached and to what level. So this problem of delivery can be solved by doing this. Then the second point is that now it comes to the money part, whether you will get the money once you have proven the delivery. So I would say that a company like us, which is also into C&I sector, the private PPA sector, so we don't ask for many payment security guarantees because we only deal with A- or better rated clients. So you can solve that problem by having a discipline when you're talking about the private sector, that I'm going to deal only with entities whose credit rating is above a certain level. And accordingly, you can design an instrument, whether it is 1 month BG or less. Problem is more once you are dealing with the government. And then you require a lot of bank guarantees or escrows. As Saurav was giving an example of smart metering, they have an escrow arrangement to assure payment. So I think both these problems, once they are solved, the problem of measuring what you are doing and the problem of payment security, then it would be a very viable model.
No, thanks. Very important, very great points in terms of A, the need for a PSM and or an escrow, whichever mechanism, which is some sort of a transient payment, and the need for an operational surety on that. Yeah, these are all. I'm coming to, okay, I had a question for you, but you can comment. Sure, please comment.
Just a small addition, and I think this is a space that in one way or the other, both Parag's firm and a few of our entities play in. If you look at SECI as an institution, it's an intermediation mechanism, right? So you have counterparties that you may not directly depend upon, but you have an intermediation mechanism, and that could be extended to especially the urban space, where you have municipal local bodies on the website. So could be replicated.
Municipal local bodies, so SECI stands behind it, like in
Not SECI
mobility.
itself, but an institution like SECI.
Like SECI, like in mobility in some way. Okay, point taken. My last question, anybody take it because it's there. The issues of capital markets, and I think you were referring to green bonds. Is energy efficiency green bonds? Is energy efficiency considered green? Can the issuances be there? So we have a whole issue of how do you look at capital markets for financing energy efficiency. Investments, projects, can ESCOs raise through green bonds? Open, whoever.
I'll just, you not only can, I think, energy efficiency for green bonds exists on a global basis, almost every major infrastructure fund in the world is financing energy efficiency as an asset. Every multilateral development bank, governments
As an asset?
are focusing on investing it as an asset in one way or another. I can't think of a single example where there's an infra fund that is not including, energy efficiency as one of the asset classes and strategies.
So, okay,
Sort of, yeah.
I have a different pivot to it.
Right, right, I expected so.
I'm not debating at all that energy efficiency should not be infrastructure and all. And I started by saying that we are never pedantic about this definition of infrastructure. One aspect, and since we track different financing mechanisms across our infrastructure projects, we were looking at some of the recent green bond issuances in India. One caveat that I would like to place, because of the data that we see, is that green bonds are effective if they give you a slightly less expensive pool of capital. But at least in India, we are not seeing that. So
No greenium in India. Agreed.
right. So with that being the caveat, I believe the plain vanilla simplest measure that we have seen on making cost of capital lower is by de-risking projects. It's a far simpler mechanism.
De-risking carries a cost.
Sorry, say that again.
De-risking also carries a cost.
Sure, yes. I mean, or efforts.
Yeah.
Cost in terms of effort, simple thinking.
Yeah, okay.
Making parties
Sure.
run through similar contracts many times over.
We'll have to open it up, but Parag, last word.
Yeah. No, as Brett mentioned, so most of the private equity investment comes from large infrastructure funds, and under that definition, definitely energy efficiency also falls. So if a firm like me wants to do energy efficiency, it has to just build a case, prove to our investor, and it can be a third line or fourth line of business for us. It is just a case that we don't see such a huge market. We don't see the business economics behind it. Otherwise, once we have a business case, a lot of our peers can get into this business.
And I want to
Yeah,
make one
sure,
very
sure.
quick comment. So the interesting thing about the rising interest rates around the world in the last couple of years is that the cost of capital has risen, which now means there's more room to discount for green bonds or sustainable bonds. They didn't exist
Right,
in Japan because
right.
cost of borrowing was so low.
Yeah, so
when it
yeah.
went up, now all of a sudden there's more
so-
room, there's more basis points to give to align
That's an
priorities.
interesting, thanks, that's an interesting observation. Thank you. We'll have to open it up for questions, and thank you all for such an interesting discussion around money matters. Money for sure matters, but we can take some 3 questions. We have show of hands, and please address your question to either the panel or any specific person that you would like to.
My name is Bhaskar from AEEE. I have 2 questions. One is that my... Yeah.
Yeah.
Is it okay?
Yeah.
I
Thank you.
have 2
Bhaskar.
questions. One is that for both the Indian panelists, my understanding is that efficiency will not get financed if there is no revenue stream, performance guarantees, etc. That's the first question. The second question is, I am an industry, I wish to replace my boiler of 500 crores, which will give me savings over the next 15 years, but there is no revenue stream. Will that get financed?
Yeah, I think that's what we were mentioning. If there is a strong ESCO agreement which clearly defines how the savings by reducing the energy consumption is going to be shared between the other party and me, and I'm dealing with a credit rated entity which is A minus or A plus better, then definitely I can take a risk of investing 500 CR. That is what I typically do when I'm selling my renewable power to a private customer.
But I just want to make an interesting point. So 500. So if you have to replace the equipment with 500 crore, and there's a high performance option that costs 600 crore, but it will save, say 20 or 15. It's not a 30-year payback. It's a 4 or 5-year payback on that incremental capital. And I think part of what we're talking about is, high performance, new construction, different ways to think about it. Because then it might make sense because there is actually an ROI in that incremental capital. You have to spend 500. The question is, do you spend, 600 to get a better performing technology?
Sorry, just my 2 cents onto it. Somehow, Bhaskar, I cannot see you clearly because of the floodlights on top of you. But my 2 cents is, when you are replacing a boiler for whatever which is more energy efficient, if it is a balance sheet funding by a company on its own, that financing is a capital investment. That should not be a problem that's dependent on. It's a question of a strategy and a decision by the user, by the industry to go ahead with it. We come to a problem of financing when it is servitized, which means I am converting the capex to a service model which is called servitization, and there will be a cash flow to the service provider who installs the equipment as an ESCO, and he therefore gets paid by the savings in expenses of maintenance, of fuel consumption, of electricity. That is where the problem comes.
So the non-servitization of energy efficiency cannot be financed.
Will not be a problem at all. It's exactly the reverse.
Only if it is servitized. If it is my own company, my own money, there is no revenue flow, but I want financing, it will not be available.
It will be available depending on what company you are, surely, because it's a asset financing, collateralization, plant and machinery, company balance sheet. So it's a question of intent and a strategy of that company that needs to change. Because if it is a corporate, whatever ratings it has, if we are talking of very small, poorly rated, poor credit quality, obviously not. But any balance sheet financing, the bank would have some relationship for it to finance any equipment. That will not be a problem. Exactly the reverse. Second question, please.
My name is Karthik. So I had a question which is, I think the context of this entire discussion has been about some sort of equipment that is being used for energy efficiency and financing that. But what about, say, capacity building for companies to be able to better use their existing equipment and infrastructure? Or even something like, say, creating cool roofs, which is not really a new equipment necessarily, which could just be painting over the roof, painting it white. Can I take that?
No, thanks for the question. Cool roofs. Okay. So urban heat, cool roofs, it's a public good, a public problem. It's a public finance issue. Very simple.
Is, why is that not happening? What's restricting this?
Not happening is policy decision makers need to take that decision and put that money as a public expenditure. So our problem here comes is sometimes our thinking gets into saying this is a public good but should be provided by private and should be financed. It will not happen. Cyclone shelters in Odisha will not be a private investment. So same thing, cool roofs will not be a private investment. It is a public good, will have to be provided by the public exchequer, by the budget, central, state, or the municipality.
I just want to add though, because and there are parts of the world where there's real ROI for associated with that. So if you're a large-scale facility, it's cold storage, and you go to white,
yes.
So that impacts the cooling costs and the energy costs associated with your operation. If you're a multi-story building, maybe not, but you're a two-story hotel, and you've got if we've got the roof here, it's going to cool this. There's going to be an energy savings. There is a real economic impact.
Sure. But what he's asking is for cool roofs for urban heat and resilience is what I understood at the question. It's for urban. Correct me if I'm wrong. If you're talking of
I'm not restricted to that.
So private property, then what Brad is saying, private property, private good, that's perfectly fine. That's a question of the property and the owner of the property being financing. Yeah, that's exactly.
And that's where co-benefits come in. So how do you basically finance things on the private side that also have a benefit on the public side, and who pays and where does that value
Yeah,
get
yeah,
created
sure.
from?
Next question, please.
Yeah. My name is Kandar Mistry from Gaitri utility side of the Gujarat state. Government is more pushing towards this subsidy model in the 10 million household with rooftop scheme. And due to more adoption in this renewable energy, there is keep away of the energy conservation aspect from the consumer, because consumers now becomes prosumer and they are not keen about the energy efficiency. So my question is, policy makers and regulators now think for energy efficiency, then change the policy, do away with the net metering and do away with the subsidy, and infuse the gross metering and infuse the energy efficiency adoptions. And for that, government may work out with the business model for, like, if we say 70% built environment is going to happen in India, then like this cellular program for the MIG and LIG, where the PMIY schemes, where the grid interactive energy efficient house, affordable housing is going to happen. This kind of model should subsidize by the government. This is the solution.
Parag.
Thank you.
Parag, will you take this?
No, I think the point is valid, but having said, if you look at the economics, so we are talking about by having solar panel, reducing the cost of electricity by 2-3 rupees or maybe 4-5 rupees in commercial buildings. But on the other hand, if we are making it zero, if we are going for the energy efficiency saving, that saving would be much higher. So economically speaking, both the things are separate. It's a question of how a businessman looks at it.
Yeah, but sir, whenever any consumer install the solar rooftop and then electricity bill comes down zero or credit in the credit mode, then he feels that I want to install more ACs and more consumption. I can easily use the air conditioning and other appliances. They are not keen about the energy efficiency aspect. That's the point.
Are you looking for energy efficiency from renewable, or are you looking for energy efficiency from coal-intensive grid power?
Reducing the GHG emissions and reduction in the energy consumption also. No.
Reduction in energy consumption from the grid or from the solar?
I think from the grid is the best.
Right. So from the grid, it will have to still be paid, right?
Yes. But sir, net metering and the energy set-off mechanism is easily compensate the consumers.
Sorry, can you explain, please? Net metering doesn't compensate the consumer at all.
Surplus energy injection, they are
Right.
set off.
So basically he's saying that the new model, the rooftop model, doesn't require even a single rupee to be invested by the consumer.
That's
Right.
And in that scenario, what he's saying is that where is
No.
the incentive for
This is
reducing the...
Surya Ghar Yojana, that is what you're saying? That is the recently launched PM Yojana, which the scheme is not yet out. I was there in.
No. Earlier state-led schemes are similar to this kind of model.
No, which state scheme you're talking of? Which one?
In Gujarat, solar rooftop scheme, Surya Gujarat scheme.
Yeah.
So the
Residential.
residential rooftop. Yes.
Right. So, sorry, we are not getting your question clearly. Can you please explain, if there is a residential rooftop solar, then the question is, the solar generation, it becomes free. There's a capex which the residence has done, right?
Yeah. And
That-
subsidy 20% and 40%.
Right.
by
So
the states.
you have gotten an adoption. So let's assume 500 units of electricity is the consumption, right? So you have a baseline consumption or something which you call a lifeline. Let's say in Delhi the lifeline is 300 units. So that much is your existential lifeline. So if within that, see, energy is also a aspect of sustainable development and energy poverty. India's per capita energy consumption, if you consider it, it's 1/20th of OECD, right? So energy is also about aspirational and about being able to live an empowered life. So you are dealing with households which are not the richer households, but you are dealing with households which are not in poverty but not empowered either. So I think that much energy consumption. Look, I mean, this problem is Europe and US have created this problem of reaching up to 400 parts per million of CO2, right? So the question today is, the developing world is participating and saying we will contribute to the cause, which is fine. But ultimately this problem is, you need to compare per capita and you look at per capita energy consumption. So I would believe in the interest of overall sustainable development goals, that much of energy consumption should be allowed, and that's actually an empowerment energy consumption for Indian lower middle class. Look at it that way. Thank you.
May I add a
Sure.
short comment? Okay, so first let me acknowledge that you know, for a distribution utility, I can appreciate the problem statement that. So let me. So you know, you are supplying power in off-peak hours, whereas somebody is using net metering and getting zero electricity. And I think your question was that if there is no cost to that resource, will I have an incentive to be efficient? And I think right now we have a, public policy is a blunt tool. So right now we have a public policy that is oriented towards more behind the meter solar supply. It may not be a perfect tool, but imagine a time when there is a time of day metering, and I think right now there is clearly an arbitrage, and you are on the receiving end of that arbitrage. But at least my sense is that technically or financially, this arbitrage would not stay forever. And I think we are already investing into digitalization tools that will one day allow time of day metering, and all these policies that are right now sweetheart policies for people to get encouraged, they will get settled down over time, and as a distribution utility, you will no longer maybe forever be at the receiving end of this arbitrage.
But the onus, there is no onus to protect the interest of the distribution entity either, right? The question is very simple. There is no onus on the policymaker to protect a distribution company at all. And why should it be at the first place? Because in Australia, if you actually look at it, people are defecting from the grid. But the grid is not required anymore. So once your renewable comes to scale and size, and distributed renewable energy was the session with Power Ministry and MNRE, I was there yesterday, it's a question of grid defection. And the question is, the distribution utility does not need to be protected. That's not required. If they can exist in the market, they can exist. That's the point. Thank you.
Thank you very much. The matter of money always stirs up some interesting conversations, so let's continue to have it during our break. Thank you very much to our panelists and Dr. Dhruva for enlightening us on this very important aspect of money, which matters a lot, but now we have also discussed a lot on how and what can make it flow. Thank you very much. And before we close the session, I would like to call upon stage Jayanta Chaudhary from IEEE to present the token of appreciation to our moderator and the panelists. Can we have a big round of applause for our panelists here? I once again would like to thank our knowledge partner for this particular session, Institute for Energy Economics and Financial Analysis, for helping us curating this session. Thank you so very much. We will now have a short 10 minutes break and move on to a very interesting session on decarbonization.